Thank you, everyone. I'm John Blankfield. I head up regulatory strategy for EMEA at Thalos. I'm delighted to moderate this panel. So this afternoon, we're talking about crypto market infrastructure, effectively the plumbing that lets institutions get involved in the crypto markets. And I think it's a generally interesting time for us to have this conversation. We see traditional financial institutions coming into the markets. We see regulatory frameworks bedding in all across the world. And then we also see the interoperability of traditional financial markets and crypto markets becoming something that was theoretical and is now a practical reality. So we've got an excellent panel. I'm really interested to see what they have to say. I'd like them to take 30 seconds to introduce themselves, maybe starting with Torbjørn.
Yeah, thanks. So I'm Torbjørn, the CEO of K33. We are an exchange for investors, for wealth managers, for businesses, offering, of course, buying, selling, and storing, market research, lending, and expanding with asset management services. So targeting the private wealth segment.
Straightforward. So hi, my name is Dorian. I represent Kraken here today. So to put it simple, we have been one of the oldest exchanges still in town. In crypto years, we're probably the old dog in the room. I don't know if some of you still do not have an account. This is the occasion. And I'll be your rep for Northern Europe in general.
Hello everyone, Daniel Arsawe. I'm Global Head of Partnerships at Bitpanda Enterprise. At Bitpanda Enterprise, we specialize in Tier 1, Tier 2 neobank infrastructure. Similar to my colleague here, we've been around a very long time as well.
We're older.
And yeah, very much looking forward to having a discussion today on the infrastructure and institutions.
Hi everyone, I'm Jennifer Shaughnessy and I'm the CRO of CoinRoutes, and we specialize in execution, portfolio management, and risk controls, and connect to 60 different venues.
Cool. We have a great gang here. So I'd like to start with the idea of convergence. And I mentioned in the intro about TradFi and crypto markets coming together. So Torbjørn, maybe we can start with you. So are traditional institutions coming to crypto, or is crypto reshaping to become more like TradFi? What's your perspective?
I think what we've seen so far has mainly been financial institutions lifting crypto into their world, right? So, I mean, obviously, securitization of Bitcoin in the form of ETFs has been way more successful to date than tokenization. However, looking ahead, I think this is about to change. We now see some of the largest financial institutions not only stopping at ETFs, they are also expanding with real on-chain services. And I think that's where the next frontier lies. So I think so far it's been a securitization game. Now the real fun happens. Now we as the real crypto players actually can start to offer the real rails, which is the blockchains.
And then, so Dorian, Kraken has Deutsche Börse as a strategic investor, and you now have X stocks bringing tokenized equities to market. So you sit at that intersection too. Like, what's your perspective on this?
Well, first, I would like to take a step back and just remember that the fact that we're just having this discussion is that we already won in some ways. I like because my banking colleagues are not on stage to contradict us. So that's nice. Well, you always need a bad guy in the room, so I'll be that one. That's fine. The thing is, when you look at it retrospectively, what we did was like cross a river to not be with the same traditional financial system that there was. And that's why people went to crypto in the first place. And we kind of burned the bridges at the beginning, but we realized that as we grew, we would never going to avoid this discussion. And now all these, I would say, interactions, you told merging, convergence, as you said. Well, this is taking place. So you mentioned our partnership with the Dutch Bourse, because essentially what we're trying to do is replicate what we are planning to do in the US. So we also have a partnership with NASDAQ through our backed finance. That's X stocks for you. X stocks, the idea is pretty simple. You have your tokenized versions of stocks. You can earn your dividends all on chain. You can move it to your own wallets. You can use it as collateral on DeFi. Don't tell that it comes from me. And that's not financial advice, by the way. Obviously, like you do whatever you want. But yeah, all these possibilities, all these like features that were just limited to a certain set of investors in the past, now it's open to any user technically. And what we are wanting to push one step further in terms of conversions is to bring the actual stocks, so that's NASDAQ for you, and to have the actual tokenized version of the stocks that would give you, for example, voting rights, property rights, all the traditional rights that you have as a stock owner, but this time on-chain, so available, I think the first target is something like 5 days a week, 24/7, and essentially we can think about a world when it will be 7 days a week, 24/7, like this is the end game, I would say. Now let's see how fast this is gonna become a reality, because we are already proceeding with the technical tests. But is it that much about the technicality of it, or is it more about like the fact that all these traditional financial markets have to readapt their ways and like stop considering that 9 a.m. is something really, really important as a time of day, or closing hour, etc.
Cool. And so we're seeing the infrastructure converge, but who's actually showing up to use it? And I think, Jennifer, you probably have some interesting insights here. So what are you seeing? Who's in the order flow who wasn't there before, and why are they showing up now?
It's a great question. In the last few years, we're seeing, TradFi firms such as Citadel setting up their own market-making teams. You've got, Goldman Sachs has a derivative desk. You've got Jamie Dimon saying that the bank needs its own blockchain. Jane Street tripled its holdings in 2024 to 110 billion in crypto. So I think these are, some major names, and in the coming years, they're just going to be investing more in the space.
That's great. And Daniel, so are the institutions you see approaching Bitpanda now, are they different to 2 years ago?
I think it's the same types of institutions, but I think the wants and needs are different now. I think initially, a couple years ago, in the institutional space, it wasn't fully formed in their minds yet. Is this a separate asset class? Does this sit in FIC? Does this sit in equities? Where does this sit in the bank's offering, if it's institutional? Is it going to stay? Exactly. Where does it fit in the bank's institutional offering? When you look at a bank implementing digital assets generally, there are multiple areas they have to consider. Custody, liquidity, general infrastructure. And with our industry, it's quite a unique infrastructure. They can't use their standard custody setup. They can't use their standard infrastructure setup, but they want some efficiencies internally to be able to use that, not to have to build everything out completely differently. So you saw a lot of innovation teams set up over the last 5-10 years with different permission versions of blockchains. And now I think banks understand this asset class quite well. They realize they can't build everything themselves, and now they look for like a modular structure where they can have access to their own liquidity, for example, or maybe directly connect to exchanges such as Kraken or brokers such as Bitpanda, but then ask for the custody services, for example, from another provider.
Sure. And Torbjørn, looks like you have something to add.
Yeah, and I think what's been very cool to see is that there's basically two Trojan horses. First was ETFs, where they thought, well, actually, now we're just going to wrap it as a stock and list it, and it's going to be very safe and secure. But it also forced all of the market makers, all of the participants that you named, to actually start participating very actively in the real spot on-chain market as well, because that's where they hedge, that's where they get the kind of coins. I mean, BlackRock's ETFs still have to hold the Bitcoin on-chain. Yes, in a partnership with Coinbase, but still on-chain. So that kind of been a Trojan horse pulling TradFi closer and into the kind of the real crypto world. The other is stablecoins, extremely hot right now. But even if you just want to have a bank consortium stablecoin, if you're going to test it on a public chain, someone has to buy ETH or Solana or whatever chain you're building on to pay the gas fee. Then there's an auditor, there's an accountant, there's a lawyer that has to figure out how to deal with this. So I see like the convergence is kind of, it's almost like a Trojan horse where they pitched like, oh, forget about crypto, it's all about DLTs. That didn't play out, it didn't work out. Okay, maybe we can take crypto, we have to pivot it into this traditional trading, and then only to realize that forces TradFi into the crypto space.
And so from your perspective, does that mean we are losing something in the kind of TradFiification of crypto?
There's a real risk of that. The biggest risk I see right now is on right to self-custody, right? There is a risk that in the future, you would only be allowed to hold Bitcoins with a regulated institution. And if we end up there, we just reinvented a new version of gold or something. It's not the true revolution that is available here. And I think also a lot of regulation is trying to really block a lot of what is innovative and functioning well in crypto. I mean, travel rule is a mess and it's directly contrary to the benefits of the blockchain.
Absolutely. And so the institutional demand is clearly there. I think all of you have been talking about that. Daniel, I wonder if I could direct the next one to you, which is what do you see from institutions when they want to white label your product? Like what are their requirements, operational resilience, regulatory, etc.? I wonder if you could expound on that.
Sure. I think there are two main areas where it's non-negotiable for them. So firstly, regulation, clearly. If you're not a regulated entity or you can't use your license to offer them the services and provisions, it's a no-go, which is a good thing because it matures the industry for us. Yeah, exactly. The other piece is security, right? They want SOC 2 Type 2 certification, etc. So these are the minimum requirements once you go through DD with the banks. Outside of that, what they want is a customizable solution, right? They don't just want out-the-box liquidity or out-the-box custody. Maybe for custody, they want it on-premise. They want to manage it themselves. Or at the beginning, they ask someone like us to manage it, and then they transition into being able to manage it themselves after a period of time.
And then Jennifer, so from your perspective, when you talk to institutional clients, what are they asking for that the market hasn't yet delivered?
Well, what I see when a traditional finance firm looks at us for execution is I see a lot more on the due diligence side and a lot more time around that. And like you mentioned, SOC 2 audits, very important. Counterparty risk, who we are as a venue, they thoroughly check out CoinRoutes. Execution has to be very provable. So these types of firms, they don't accept trust me, bro. They want you to measure everything. TCA, they also, as far as the reporting side goes, very thorough reporting.
Absolutely. And so one of the things that I've been quite interested in recently is whether the liquidity is there in European markets. And so I'd like to take a closer look at what institutional execution in crypto markets in Europe looks like. So, Jennifer, again, you see institutional order flow across a wide range of venues. What does European crypto liquidity look like at an institutional level? Is it there? Is it sufficient? Is it fragmented? Is it on Thalos?
Yeah, that's a good question. So, the way that we see European liquidity is, so they have to be pooled off, according to MiCA regulations, which does cause fragmentation. And it causes a lot of this liquidity to be a bit patchy. So it requires aggregation. Also, when you're trying to move serious size and you've got these pooled off liquidity pools, you can end up really moving the market on these euro-denominated pairs, especially if they're illiquid. So you need a system like ours, basically, for this type of liquidity.
Absolutely. So Torbjørn, obviously you're active in the European crypto markets. Are your institutional clients finding it difficult to get the execution quality they need? Is for similar reasons? Is the liquidity there? Is the depth there?
So I don't think the liquidity is in the European market. And the fiat rails are also really not great. So all the liquidity, or most of the liquidity, is in dollars and in the US. Yeah. And what we've invested a lot in K33 is optimizing the FX, both kind of rails. We're banking with tier 1 banks in Norway, which is a low risk jurisdiction and very well connected globally. It's kind of giving better settlements for our clients, but also really optimizing our FX execution, because we are not going to find liquidity, obviously not in the Nordic currencies or franc or pounds, but even in euro. The liquidity is not in euro. So we are sourcing in dollar, but then pairing that with superior FX execution, because it's not a native and deeply liquid euro market, at least not yet.
Makes sense. Sure.
I think to echo this point, especially in the crypto market specifically, if you have a very large order and it's you want to exit on euro rails, for example, most of the time it's a triangulation trade, right? It's going to always go in the most liquid markets in dollar, as was mentioned, and then it's going to come back out to euro, and you just have to manage the FX.
Makes sense. Dori?
On this point specifically, so we have been the oldest having euro rails as an exchange since already like 2014 something. And the liquidity in euro is much lower than what you can expect from USD. But what is also true is that currently the institutional flows that we see from institutions in Europe allows us to do it, especially when you cope it with some OTC, and you do mostly OTC for these requests up to a certain level. And OTC is available for all institutional clients anytime. You get your own quote specifically, etc. In terms of execution, it's still very seamless, but it's actually better for institutions from my understanding, because especially when they come from TradFi, they have this habit of OTC much more than what we have as institutions, crypto native institutions, where they want to interact with the order book straight. They want to see like how they interact with the market. For TradFi institutions, it makes much more sense to communicate with us, get the quote, settle on a price, etc.
Just one
Of
last
course.
piece. On the liquidity piece, if an institution wants to do a big block trade, as was mentioned, we've seen that they don't want to get involved in connecting to all the exchanges. Liquid exchanges like Kraken or Bitpanda or Binance, if you want other liquidity, they are not comfortable facing that as a counterparty. So they come to venues such as ourselves to be able to execute. We take on the counterparty risk on that side, and they get the liquidity. But I think that's where the most usable liquidity piece is from the businesses that we work in at the moment, as opposed to just managing the liquidity. The banks enjoy the fact that they can face a regulated entity and execute with almost unregulated levels of liquidity.
Okay. So the theme I'm hearing there is clients increasingly want things all in one place, right? And so you talked a little bit there about how Bitpanda is meeting that challenge, but maybe could you expand a little on that as well?
Sure. So let's talk liquidity, for example. So we connect to 20 plus exchanges, including Kraken, OTC desks, and other market makers. And then we give the client a blended price, right? From that standpoint, for them, liquidity depth is good. So that solves an issue for them to connect to 20 venues, fix or WebSocket connectivity, managing counterparty, leaving funds on the exchange. Some of them will do credit lines, but still there is some exposure of funds across these different venues. So it makes a lot more sense for capital efficiency for them to face one counterparty and have access to many. From a custody standpoint, again, similar to what I said earlier, they can build their own custody, or they can have a solution which is customizable for them. And that's why at Bitpanda Enterprise we have a modular solution which allows them to take custody only, take custody and liquidity, or take the whole white label infrastructure.
Cool. And then, of course, Torbjørn.
I was just going to add, because on the one side you see decentralization, right, where in the private wealth segment we see the same, right, that they don't want to have accounts on a ton of different venues to have the full access. They want to have us as the broker serving that, whether that's lending, whether it's derivatives that we are developing now, or kind of the liquidity for a big trade. At the same time, we see the value chain fragmenting, because in the good old days, the exchange was the custodian and the market maker and had like everything in one player. Right now, we're seeing that we have clients that want to have their own custody or do custody with another kind of third party, which is not the K33 as custodian, but they still want to trade and execute with us. So I think we're going to see more of the structure from finance where these different roles get divided and not necessarily bundled together.
Okay, interesting. And some of that tallies in with kind of the more crypto approach to things, where you have the decentralization, maybe the sort of, in some senses, fragmentation. But what you're saying is there are benefits to that, as well as, not over-centralizing. So I'd like to talk a little bit about tokenization of securities. We talked a little bit about X stocks earlier. It's obviously the big brand name in the space at the moment. And so the infrastructure underlying that is maturing, but I'm curious about the assets themselves. So tokenized securities are now real through things like X stocks. But what are the remaining obstacles? I'd like to maybe go to Dorian first, given I've mentioned XStocks 3 times.
So actually, the remaining obstacles for that are very clear. For now, there is no equivalence between these tokenized assets, tokenized stocks, and the stocks that you own on a broker traditionally, in terms of especially voting rights, property rights, etc. It's diluted, and your property rights are, acknowledgement of debt rights, let's say, are towards back finance, towards XStocks. So there is still some kind of intermediary, and that's why it's very important that the actual stock exchanges, and I'm not talking only about NASDAQ and Dutch bourse, because they understood it and they are already doing this, and also the New York Stock Exchange, by the way. So that they already understood this, but there are many, many stock exchanges in Europe, for example, that could perfectly be faster. They are smaller, they should be more adaptable, more. We won't say anything about the Nordics because I really feel the compliance vibe is particularly strong here. But and my idea is there is really an opportunity to be some kind of standard setter, like to create the standard that everybody will use afterwards. So it seems that NASDAQ and New York Stock Exchange are going to be that. Let's see what Europe does, because in the end, we talked about a lot about MiCA throughout this entire conference. The reality is, if everything goes through as we see in the US, they will have a much clearer package to prepare this tokenized stocks equivalents, and therefore have them liquid, because that's what we want. Like you talked once again about the inconvenience of this. So there are these different types of rights that you don't have yet. There are some things that are cool. As I said, like you get paid in dividends straight on chain. So you accumulate tokens straight. No need to go back to fiat. And the issue is liquidity for now, definitely.
Okay, perfect. And Jennifer, so from what you're seeing in terms of tokenization, which jurisdictions do you find are leading in the space? You know, we see developments obviously in Europe with XStocks. We see in the US, there's recent SEC kind of moves to liberalize that regime. And in APAC, we see progress. But where do you see the biggest strides forwards coming?
As far as strides in regulation around XStocks, you mean, or tokenization of real-world assets?
Yeah.
I think, we're seeing real-world assets on our, platform kind of in their early days, so we are offering them on Kraken, and we see that you guys have put a lot of volume through it. I would say 25 billion. Yeah, and I think in 9 months it went from 2 to 25. So you're seeing, extreme, I would say, demand on it. We still see a bit of we're anticipating some fragmentation. So we are offering multiple exchanges, though we do recommend Kraken for XStocks. And yeah, I think that's the take that I can basically offer, just because I'm seeing it more from how traders are using it operationally.
Absolutely. And I think I'm interested in, and you'll forgive me for a regulatory question given my background, but I'm interested in Europe's regulatory choices and the impacts on institutions. So these things don't happen in a vacuum, and they're being shaped by regulation and constrained by regulation. We've recently seen, and sorry to bring up MiCA again, but we've seen a consultation by the EC recently on changes, proposed liberalization maybe of MiCA. Let's be generous. So I'd like to move on to kind of looking at these choices and what they mean for institutional business. And so Torbjørn, if I could go to you first. So in terms of MiCA, are you seeing it create a coherent European market?
No. I mean, MiCA is giving credibility to those who obtain the license. It's pulling up the ladder, so it's reducing competition and creates a barrier to entry and higher profits for those that are within. But it is a mess, right? I mean, it's interpreted different by every country within Europe. And it's a severe overregulation. And what I mean about overregulation is that this never-ending demand for writing down and documenting the documentation of the documentation. And it's like 75% of it has nothing to do about actually increasing security or clients' protection, but has to do about kind of ticking boxes in a new way. And I think it's blocking innovation. It's pushing all of the innovative projects out of Europe. And I think what you're going to get is a MiCA-regulated bridge that takes you on-chain, and then an non-MiCA regulated kind of offshore ecosystem that you can access by going via the regulated bridges. But unfortunately, that pushes innovation away from Europe, I think.
Absolutely. And Daniel,
If I can
Oh,
just
sorry.
illustrate,
Sorry.
because that's you described exactly the situation, what is happening. In Europe, we have only one crypto company native to Europe that crossed the 2 billion valuation bar. It's called Morpho. It's a DeFi project. It's not under MiCA. Is there a question there? I don't know. But exactly the situation he said.
absolutely. And Daniel, so what are your institutional partners telling you about the problems they encounter with regulation, and how are you helping them solve those?
It's interesting because when MiCA came out, we assumed, at least internally, that, okay, this is a no-brainer now. If the bank is interested, regulation now is ticked. So as long as we have everything else in place, this should move quite quickly. What we very quickly realized was, even if MiCA is approved and we are regulated, we have 3 MiCA licenses, we're sitting with a bank, and then there's still questions from the compliance and legal and regulatory team. Is this possible? Is this legal for us to offer? Should we get our own? If we get our own, there are many things that we have to put in the application form. So now it's a whole new process for them. That's in the more advanced banks and countries. In the countries that haven't got any major companies operating with MiCA, specifically homegrown from that country, we've seen a lot of hesitance in terms of needing approval from the central bank in that country, even though technically they don't. It's more a notification. But so, to your point, it's caused confusion, even though technically it was supposed to standardize across all of Europe. There has been some hesitancy. It's better now than when MiCA first came into effect, so we are progressing, for sure. Baby steps. But eventually I think it will harmonize. And I think once you have the European countries that have no MiCA-based businesses operating homegrown, once you have them there, then I think you'll see the standardization a lot more.
Okay, and I think what we're kind of seeing is a divergence really between, say, the EU, the US, to a lesser degree the UK, and APAC. And so, Dorian, I mean, we've talked about MiCA being live. There's obviously recent developments on Clarity, finally making it to the floor of the Senate. Let's see if we actually get any further than that. Fingers crossed we do. But where do you expect the US and the EU to be in, let's say, 3 years? I mean, it sounds like the message is very strong divergence, but I'm interested in whether you agree.
To be honest, this is a very personal question, so my answer will be just my opinion and not Kraken's take on the future, because this does not exist. But on my end, I would say that, the conversions, as you call it, will be much more seamless, because in the end, that's the end goal, is that when you will be trading on your traditional stock exchange broker, etc., you will be using blockchain technology, and that was the goal from the beginning. You will not know even that you're using that. The only indication will be that the markets will not be closed when you're trying to trade. So that's for that. But fundamentally, it's also about the perception. I think in Europe, we're still lagging behind in the sense that we have a lot of institutions who still believe the technology is not going to stay, which at this stage is very divergent from what we see in the US. But once again, there is a lot that is at stake right now. It's not decided. It's really a work in progress. And that's why you have all this, I would say, these expectations around what's happening in the US right now. Like they gave this estimate that there is about 6 times the level of volumes that are already in the ETFs that are waiting to be poured in Bitcoin especially, but let's say crypto markets in general, from institutions who still do not want to set plans and invest in crypto markets because they make plans for like 5-10 years. And if whatever they make as a plan right now gets contested later on by, let's say, for example, a new administration in the US that would be much less pro-crypto, then their whole long-term strategy goals would perish in the middle of their execution, and this is not a risk that they're entitled to take. So that's why right now, if we have this foreseeability in the US, the levels of liquidity and volume that we will see will be dramatically more important. Doesn't mean that it will be all at once, especially traditional TradFi institutions don't do that. They come there smoothly. They buy over time, they sell over time, etc. So yeah, that's my take for the 3 years.
Thank you. And then Jennifer, so you obviously serve clients globally. How do you see the divergence in regulatory regimes, and how does it affect how you develop the product?
Yeah, that's a great question. And like you mentioned, Clarity passing Senate banking is very exciting a couple of weeks ago. I personally do think that we're going to see them kind of run in parallel until there's some sort of convergence on what will work, but I think that that's going to come in the future. And I think as of right now, the U.S. is going to continue to stay in the lead around derivatives. I believe Mika still has some challenges and some friction around that, though Kraken may have solved derivatives. Are you offering, I think you're offering derivatives for European clients right now that's outside of, MiFID. So I think there are some workarounds, but basically the way that we're going to focus is by offering, all of the centralized exchanges in one place. We're offering Hyperliquid, we're offering Lighter, we're offering Aster, we're offering all of the plumbing that works within different jurisdictions until then.
Great. Okay, and then I'd like to close by asking each panelist a question with the same question, don't worry. So if you could change one thing to accelerate institutional adoption, what would it be? Maybe Jennifer, since you've got the mic, you start.
All right, good question. I think the execution piece is solved, and portfolio management, risk controls have become a lot more robust in the last year or so. Where I think the new frontiers are is cross-exchange settlement, cross-exchange margin, frictionless lending. This is I think the new frontiers to focus on for institutions that want to trade crypto.
Daniel.
I think it's going to be a capital efficiency play. So some form of prime. Bitpanda is also offering, Bitpanda Enterprise offers a prime product where effectively clients have a credit line, institutional clients have a credit line, settle end of day. I think this will get them more used to what it looks like in the traditional markets. And as you increase capital efficiency, the P&L opportunity gets greater, and I think this will accelerate adoption for us.
Great. Dorian.
So I'm going to take this exercise as a thought process. So go with me because it's going to require a bit of imagination. I would like the fractional reserve of banks to be removed as a possibility, so that they would not use their crazy, powerful lobbies to prevent competition from entering the space that we're all in, especially regarding stablecoin rewards, interests, etc. Because what's happening behind the stage is pretty simple. Any $1 USD that is brought to USDC means they are losing something like $9 on the stock exchange. So you perfectly see that if they just have 5%, of deposits moving from their USD balance to stable coins, they lose a massive amount of capital that they do not have the backup for. And that's why there was actually a solution from one of the previous panels that was actually interesting. The bonds from banks that would make them able to self-finance. I don't think it still works with the fractional reserve model that we have right now, but I would like it to think that it could be removed, so all this pressure would go away and the competition could actually take place. Because right now, they settled on some kind of agreement in the US. So to give you the agreement that we have at the moment is that no passive action with the stable coins will grant you passive rewards. So there will not be any equivalence to what the banks are offering when you just pour your money on your deposit account and you get some interest rates. But there will be a possibility for active actions to bring you interest rates. So typically lending protocols, using DeFi protocols straight from centralized places, or deciding really to lend on the platform because we have all these credit lines, mechanism, margin pools, etc. So all this will be possible. That seems to be the agreement that stands right now at the moment. Let's see.
Thank you. And finally, Torbjørn.
Yeah, but I'll echo that point because I think, well, institutional adoption is happening. It's going to continue to happen, but it's going too slow. And the reason is very simple. It's not enough competition between institutions. Because if it were, they would be more willing to take the risk. Someone would actually embrace this faster to win more market. They're not doing it because they have these nice profits from the barriers to entry. It is a real cartel. Why are they afraid of stable coins offering yield? Because they're not competing against each other. If there was true competition between these players, those margins would have been kind of competed away. And it's the lack of competition in traditional finance, partially caused by over-regulation, that is blocking the appetite of embracing new opportunities, because it's easier to defend what is already there than for a small new player to kind of make the new future.
So, thank you all. So, 4 really different perspectives. Some common themes there. You know, infrastructure is maturing, but there's still a lot of work to do. Will you join me in saying thank you to our panel? And thank you for your attention.